further ado, 2023 opportunities, how to take advantage of the real estate market. A few things we want to cover are the disclaimer. Boost Capital Group does not provide legal or tax advice. The material hidden is provided for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy or sell securities. Your host tonight, myself and Philip Schuligan, we are co-founders of Boost Capital Group, a real estate investment firm and provider of investment opportunities, risk mitigation, and portfolio diversification through alternative assets. Our philosophy is that we feel that busy professionals should not have to compromise time in order to spend quality time with their families and securing their financial future. We have been investing in alternative assets for over a decade now, and we are invested in 2,800 multifamily units across multiple states, and with the average IRR of 20%. So today we're going to go over the investment market and its challenges, how to select real estate investment strategies for 2023, and evaluating the potential investment opportunities, the future of real estate investment and emerging trends to watch, and strategies for optimizing your tax efficiency and maximizing your wealth. So the real estate market has experienced significant growth, as we all have seen in the past several years. If you look at the commercial property price index to the right, it pretty much dictates what investors have seen, that the demand for residential and commercial properties has increased in the past several years. We expect this trend to continue. And if you're not familiar with the CPPI, it's pretty much statistical measures that are used as benchmarks to gauge the movement and performance of the market. So in this case, the real estate market. Therefore, investors show interest on what they see based on data that's put out, such as this CPPI for real estate sector. So the US economy has enjoyed low interest rates. This is one of the main features of why the real estate market has grown a lot. And then in response to COVID-19, the Federal Reserve pretty much slashed prices down to zero in order to help fight inflation. Now, because of the low interest rates, housing affordability was more attainable, and because of that, the shorter supply of housing increased prices of available properties, both residential as well as commercial. These monetary policies that were loosened by the Fed did a lot to the economy. It made more capital available for investments, as well as acquiring or the purchase of residential properties. And with the Tax Cuts and Jobs Act, it also allowed Americans to keep more of their money that they made versus paying a lot more in taxes, as well as the Job Act also brought in the bonus depreciation of 100%, where before it was 50%. So there's a lot of things, a lot of variables that went into boosting this economy. Excuse me. But at the same time, a lot of these variables are causes of the challenges that we're facing, or that we will be facing. So as the Fed increases the rates 7 times in 2022 in order to fight inflation, the higher interest rates have made it more expensive to acquire multifamily properties, residential properties, or just any commercial properties across the board. Housing affordability has become less because of the higher interest rates we are facing. And the supply, the shortage in supply has also kept up with the prices. It keeps the prices up because of the low availability of real estate in the market. And these all go back also to the changes in government policies. Now we are tightening, the Fed is tightening the rates, increasing the rates, so therefore affecting the entire market. So here we have a graph showing inflation. So inflation is something that's been talked about for a long time. The Fed, they felt they had ascertained pretty much the cause of inflation, therefore called it transitory. But after a lot of after the market started opening up and the bottlenecks started showing up, they determined that the inflation is not transitory and that they needed to take action, which was the rate hikes. Now, low unemployment is a problem for the Fed, right? So with low unemployment, it means it's a good job market, but the Fed, in an attempt to slow down the economy, they want to keep raising rates in order to cool this economy, therefore increasing unemployment. Right now, it's expected that the Fed is going to raise rates for another 100 basis points in 2023. But the past real estate has been recalibrated because of the interest rates. So because of the low interest rates before, properties were a lot more attractive and not as expensive, therefore, making it hot. But with this increase, it's helping cool the market, but at the expense of higher cost overall. Now, selecting the strategies for your 2023 real estate investments, there's a lot of things to consider. Different investment objectives, risk tolerance, expertise, and time available. We'll dive deeper into that. So a survey of consumers' finances. So more than 40% of the portfolio of the wealthiest families are made up of real estate. So if you're here, you're in a good place, because real estate investments are definitely essential for wealth and legacy growth. As you can see here in this chart, we updated our chart to 2023 edition of the 5 ways to boost your capital beyond your retirement account, where we compare multifamily, single family rentals, real estate investment trusts against each other to show the returns and volatility on the scale to help you best decide what fits your investment goals. So here, what this image, which I really don't know where we got this image, but what this dictates or depicts is that you have multiple strategies to reach your goals. Strategies are the first thing that you want to work on. Tactics are how to get there. So you, as the investor, as the wealth builder for your family, need to know what kind of tools you have in regards to credit scores, access to capital, the knowledge you have, access to people. So you in place these tactics, which would help you create an action plan to get and develop your strategy on how to best achieve your goals. So these are other things to consider when creating your tactics in order to for your strategies to achieve your goal. What are you looking for? Are you looking for cash flowing assets? Are you looking for capital growth? Or are you looking for both? What is your time horizon? Are you retiring soon, or do you have 15, 20, 30 years to invest? All those play important factors on how your strategy is going to be put together. The skills required: what do you know about the real estate market? What do you know about acquiring property, managing properties? Can you leverage time of others? Do you have all the time to make these type of investments? So those are things to consider. What kind of skills are required and the time commitment. A lot of busy professionals we speak to do not have the time to pretty much create another job on managing property, researching property, analytics, trends, and all those type of things. So you got to consider those time commitments and time constraints. The safety. So is your market regulated? We can talk about Bitcoin, how there's been a lot of Bitcoin news here in the past 6 months, especially. You want to look at what kind of markets are you going into when it comes to your investments. Are they regulated? Can your investment go to zero overnight? With real estate, your capital is pretty much backed by real property, which just can't go to zero for the most part, because you always have either an insurance policy or the property, for the most part, is not going to get up and disappear. The tax benefits, if you look through the tax code, through the IRS tax code, there's a lot of benefits for investing in real estate property. So always, consult with your CPA or tax professional when it comes to that, because not all plans are for everybody, but those are definitely huge benefits when it comes to investing, part of your investment strategy, and as well as your returns. What kind of returns can you expect to get from real estate investments? The risks that are associated with these returns, they all have to pretty much fit in your wheelhouse on what you're comfortable with. Now, there's critical factors when it comes to evaluating potential investment opportunities. And obviously we're going to go over them, but just to touch on them, we want to evaluate the opportunities, location, the market trends, analytical data, property types, the value proposition, financial metrics, competition, and risks associated. Now, location. It's always been a pretty much a theme for real estate. We want to make sure that when you are investing in a market, that everything you need in order to have a successful investment is in place. You want amenities, you want transportation, you want job growth, you want to make sure that it's attractive for both tenants and buyers. So if you're investing in real estate, in commercial real estate, such as retail or multifamily, you want to make sure that there are modes of transportation. You want to make sure that there is going to be people buying things, moving around. You want, population growth. And consider the property type. That depends on your appetite for the investment that you're looking to put together. You could have multiple strategies. You can invest in multifamily, but you could also invest in self-storage. So a lot of those things go into place on the property type, on what you want to invest in. You can invest in single family homes, but those are better for long-term appreciation based on the tax code. The market trends, such as demographics, supply and demand, those are things of interest that a investor will want to know on how to better gauge and communicate with the data that's available, and even indexes, how that market is going to grow for the next couple of years or so. And the value proposition, the type of property that you're interested in. You could do a value add property where it requires you to have some capital, lower the expenses, increase rents, or you could go in and buy a A-class property where there's minimal capital needs for it, but you're in a hot market where the rents are really high because there is a lot of job growth and income is really good. So there's a lot of different things to consider when looking at the type of property you want to be a part of. So the market trends and analysis. So definitely the demographic, a strong migration pattern. So a market that you have seen a lot of movement towards. A lot of states, Southeast states have, or even Texas, have seen a lot of migration movement to those states because also there's a strong job growth. There's a strong job market out there. A lot of big tech companies are moving to Austin, for example. So that brings a lot of people, a lot of job growth, diverse employment. You want to look at, do you have multiple employers or do you have two major employers? If something happens and one of these type of employers loses a contract or something like that, that could have some effect on your income base for the rental properties you own. And of course, upward trajectory of income with job growth, more people, and diverse employment base. Usually there is a higher weight, new investment or new builds, for example. So are we looking at new construction? Are we looking at proposed projects, planned projects, projects under construction, newly built? Are we looking at a 1-3 year projection of units that will hit the market? So if there is more supply than there is demand, that's going to affect the vacancy rate, it's going to affect net absorption, and it's also going to affect the rent growth of that area. So if there's going to be an overbuild of, say, multifamily apartments in an area, that might be a deterrent for you to in that area because of too much supply and then not enough demand. So those are things to consider. A lot of investors focus on demand by looking at the current vacancy levels, net absorption, historic and projected rent growth figures. Now for the economics of the condition, market economics, what major leases are there? What big players in real estate, or is there a huge Google from Tesla taking up, signing major leases, because that means more job growth and more money in the area. Sales transactions in that market that you're interested in investing in, has there been a lot of transactions? What are the figures for those transactions? What kind of investment figures have the local government, what kind of investment figures has the local government considered? What other investment figures is there BlackRock investing in that area? So that goes down to investment firms. Is BlackRock buying in that market as well? They spend a lot of time doing due diligence, a lot of money determining what markets they want. So if you're in that similar market and you see what other big players are in there, that's also part of the analysis that you would do for your market economic conditions. Now, the future of real estate investment and emerging trends to watch. So we look at a lot of data, a lot of trends, a lot of big players put these documents together where it shows where the expectation of the real estate market. We cross-reference information. It's all data-driven. It's the best way to better gauge where capital is going to be spent, where investor sentiment can be, where big corporations are going to invest in. So by looking at some of these real estate reports, that helps better identify and paint a better picture of what across the board people are thinking, corporations are thinking. So those are always good resources to use to make these decisions. So here we have data from one of these documents. 2022 is the bubble without the clear bubble. So there's movement of interest for fulfillment centers. These Amazon fulfillment centers, things of that nature, they were really hot during COVID. But as things start to slow down and the market opens up, this trend states that fulfillment centers are not going to be as investable as they were before. And then if you look at the top for moderate income workforce apartments, there hasn't really been much of a shift from 2022 to 2023. It's still going to be a great investment option. But these are the type of data points that we like to look at and cross-reference. Next, you see the by sector apartments, up 43%. They lead in confidence and volume of transactions. So there's a lot of transactions for multifamily apartments, especially with these low interest rates. There definitely was a lot of transactions. Now with cap rates being changing due to the interest rates, properties are looking a little bit more attractive. However, there's still a disconnect between sellers and buyers, but that's something we could discuss at a later date. This right here, what you're seeing is this horizontal line are the historic norms, and the vertical movement are permits. So as you can see, what this pretty much is saying that the historic norms, the horizontal line, and permits are not meeting eye to eye in the center. So meaning there is not enough properties, single family and multifamily, being built to keep up with the demand. That's pretty much in a nutshell what this graph is telling you. Look for population growth and look for inventory in lines with population growth. So this right here shows what to expect for the inventory growth and population growth for 2023 to 2027. As you can see, for example, Phoenix, Austin, there's a lot of growth. You see all these large these green bubbles above 3% of growth. We actually have available investment opportunities in these markets as well: Houston, Austin, and Phoenix. These are great markets to consider when you want to invest in an asset. The Northeast is not doing so hot. It's actually declining. You have a lot of people migrating to the Southeast, as we discussed earlier. So those are things to consider in emerging trends, which have been happening for the past couple of years. But these are things to consider when deciding on your investment opportunities and location. Additional trends to watch: short-term debt opportunities. So there's a lot of high interest rates right now. A lot of rehabbers, flippers, construction of single family properties are looking for capital in order to complete their projects. There's debt funds that allow investors to participate, put capital into, and invest in short-term debt. So you pretty much are the bank at that point through the fund. So there's a lot of benefits to that, and these are emerging trends to consider, as well as short-term rentals. We're keeping an eye on that. There's a lot of funds as well for short-term rentals. And they've been around for a long time. Airbnb, still continue to grow in popularity. However, there's a lot of government policies or even local municipal policies that are making it difficult for Airbnbs and short-term rentals. So when considering investing in these type of assets, you want to know what kind of laws or governance is being changed before you invest in a certain area for short-term rentals and opportunity zones. They've been around since the 2017 Tax Cuts and Job Act. That was one of the benefits that came out of that. What this allows you to do is to invest capital into economically distressed areas. The benefit of this type of investing is if you sell, say, your stock portfolio, you can invest all the capital into an opportunity zone, defer all your profits, and if you hold it on for 10 years, then you pay no capital gains tax. However, there is if you want to do for shorter time frame, they have different breakdowns of that time, but it has not really gained too much in popularity. And this is something that we don't really invest in. But if there's someone that's interested in that, we could connect you with the right people for opportunity zones. So as stated, these are the data points that we use in order to compare different markets. These come from two different reports. The blue stars represent the cross-reference in similar cities. The gold stars represent where we are currently have investment opportunities. So this allows us to kind of cross-reference cities that multiple data points state that are going to be good for markets to invest in. So it kind of helps identify these locations versus just using one set of data points. And now for strategies for optimizing your tax efficiency. So we're not CPAs and we're not tax professionals. However, in real estate investing, we understand there is a lot of benefits, and we do talk a lot about the benefits that it provides. All benefits are not for everybody. If you're a real estate professional, you do get a lot more benefits that do fit that can fit your need. So that's what we always recommend. Please talk to a CPA or a tax professional before investing in real estate. However, like I stated earlier, the tax code does provide a lot of advantages for investing in real estate. These tax benefits, tax exemptions, and tax rebates can help, lessen the tax burden if you need be. So investments in tax deferred accounts, we work with investors that have self-directed IRAs, solo 401ks. They help you defer taxes. All your investments stay within that vehicle, and you have a custodian pretty much managing that for you. We work with the custodian to help streamline any investment situation to simplify things. You have tax advantage of depreciation, which is something that you get through the tax code through properties. And then, using a 1031 exchange, if you own a large asset and you want to sell it, you could also do a DST or through a 1031 exchange where you could defer your taxes, multiple times until whenever you feel the need to collect completely. But also there is another vehicle that if you're a business owner and have no real estate, but you want to sell your business, there's another vehicle that's available where you can defer taxes and invest it into a real estate transaction and benefit from that and not have to pay taxes. You could defer taxes from that. And we can put you in contact with the right people for that as well. Just always, feel free to reach out. So in conclusion, as stated, your time is valuable and you are valuable. 2023, the real estate market is expected to offer many opportunities in the coming years due to growing demand, supply shortage, emerging trends, and low unemployment. However, preparing for this inflation is optimistic. Therefore, investors should prepare for higher interest rates and high inflation. So it's important for investors to take advantage of real estate analytics and trends in order to help achieve your financial goal. I'm going to go to Q&A. Please feel free to type in any questions you may have. That's that QR code. You can scan it. We could schedule a one-on-one call as well. You can find us on Facebook, LinkedIn. If you want to shoot us an email, info@boostmycapital.com. But like I said, if you have any questions, please drop them in the Q&A. Reach out to us. You will get a follow-on email for attending our webinar. Again, we appreciate your time. If you have any questions, please go ahead and schedule a call with us. Send us an email, and we'd be more than happy to connect with you and schedule a one-on-one call. But again, we appreciate your time, and we look forward to connecting with you and having a better experience next time on our coming up webinar for March. You will get an email about it soon. So thank you for showing up, and we look forward to working with you.